Scott Miner, the Global Chief Investment Officer at Guggenheim Partners. Thanks for your time.
Great to be here, Scott.
So the March jobs report is released on Friday. Give us a sense of what we should expect and what you'll be looking for.
Well, I mean, look, the month-to-month job reports numbers is a really erratic number. And I don't make too much of any particular month's job report, especially given the tendency to get such high revisions. But what we should be looking for is continuation of employment growth, continuation of wage growth, more hours worked. It's very clear that the economy is gaining momentum. It is part of the Fed policy to try to continue to drive unemployment down. And with unemployment falling the way it has been, we're going to see more and more wage pressures, which is what the Fed would like to have. And wage pressure is one of the key components in terms of what the objective of the current policy is. So should we see, real large upside gains in wages, which I'm not expecting, we might think that the Fed would act sooner. But in all likelihood, just good, solid, continued wage growth is what we want to see.
So how can the Fed raise rates if we're in this environment of tepid wage growth?
Well, I think that they're going to be looking at the unemployment rate. Historically, as the unemployment rate falls below the level of full employment, which is a debate of where that is right now, that wages begin to start to accelerate. I think that the Fed believed originally that full employment was somewhere close to 5.5%. They're now starting to talk about it maybe being closer to 5%. And Dr. Yellen has made it fairly clear that we'll know full employment when we start to see wages go up. So as long as we continue to make progress on employment, I think the Fed has confidence that wages will eventually follow.
But do you think we're making progress on the types of jobs being created? One of the themes of this recovery has been these low-paying, low-quality jobs. When are we going to start to see some higher quality jobs enter the market?
Well, I think that there are two issues here, right? One is that we have to get the surplus labor back to work. Once you get people back to work, or there's a prospect of finding jobs, people will then be incented to invest in education. That is, whether it's technical training or some other form of training which would increase their job skills. Education is a major problem for this country. And until we can see more of a focus on quality education, it's going to be a real challenge to get the high quality jobs back.
And of course, investors are watching the Federal Reserve very closely as it gears up for its first rate hike since 2006. But inflation still remains weak. We just had core PCE released earlier this week for February, and it's up only 1.4% over the past year. The target is 2%. How do they grapple with this?
Well, I think that the Fed is looking for what I've called the trifecta, right? They want to see low unemployment, they want to see wage growth, and they want to see inflation approaching 2%. The reality is, I think they've told us that they're not going to wait for the trifecta to begin the process. The argument is that even if rates were to be raised by, let's say, 0.5%, monetary policy would still be highly accommodative. And so the Fed, as long as it has progress on the employment front, it has confidence that wages are going to go up. I don't think they're going to necessarily have to see the inflation rate reach 2% before they take action. But over the terms of the cycle, they'd like to see it get there, and I think that'll be a more important component down the road as we continue to see whether we want to continue to raise rates or slow down the pace.
Scott Miner, great to see you. Thanks for joining us.
Thank you, Scott.